Hello, fellow Rebel Capitalists. Hope you are well. I've got my good buddy here, Jeff Snider. There is a lot going on in the news right now pertaining to the Eurodollar system and the global monetary system. And I've done a lot of these videos, and I got the idea from you, Jeff. So I need to give you full credit here. And listening to your incredible podcast, which we were just talking about, Eurodollar University, and you started to point out that, hey, these swap lines, or the swap line with the Swiss central bank, is starting to be utilized. And basically the way this works are these banks, these Swiss banks, and maybe some other banks that are using them as a subsidiary, they go to an auction, which is held every single Wednesday, from what I can tell. And usually they have no bidders, meaning the Swiss National Bank. No one really needs dollars. But lately that has changed. So why don't you walk us through what has happened, and then I'll start drilling you with the questions.
All right. Yeah, George. The Swiss National Bank actually doesn't auction its own dollars. These are these overseas dollar swaps that tie back to the Federal Reserve, to the Federal Reserve Bank of New York. They call them central bank liquidity swaps. They used to call them foreign exchange swaps. It doesn't really matter what they are.
Yeah.
Essentially, the Federal Reserve has a dollar swap exchange. It's, as the name implies, swap with central banks, a standing line with central banks around the world. The Swiss is one of them. Essentially, whenever there's somebody at a Swiss auction, the Fed credits the Swiss National Bank with dollars, and it's up to the Swiss National Bank to distribute those dollars to the banks that show up as you said, George, these are weekly auctions. And typically before this year, or before this month, actually, they would have a dollar auction every week and nobody would show up, which, yeah. I mean, that makes sense. The private market takes care of all the
fun. To stop, just so everyone's following along, and this is a question that I've had too. When the banks are getting the dollars from the Swiss central bank, is that basically a repo? Is that collateralized or is that uncollateralized?
Everything central banks do practically is collateralized. So yes, okay. This is so if you're participating in this Swiss dollar auction, it's the same eligibility requirements as if you were doing a Swiss franc auction. So you have to post whatever collateral the Swiss National Bank deems as eligible. Okay. So in this case, it's probably euro-denominated government bonds, which kind of makes sense when you start to think about what might be going on here with Italian bonds. We can get into that later. But essentially, up until October, nothing going on. Swiss National Bank, weekly auction, nobody shows up. Occasionally, there'd be a couple million here or there, usually rounding errors, test programs, things like that. And the first week in October, and if you haven't noticed, things have gotten pretty interesting, as you said, lately. So it was interesting that the first week in October, suddenly there's 9 banks showing up at this dollar auction wanting 3.1 billion. At first you think, okay, end of quarter, maybe there's some hangover there. You never really know. And this is for a 7-day term. So these are weekly auctions where banks get dollar funding for a whole week. So maybe the first week of October is a little quirk. Second week in October, it goes up to 6.27 billion. And now there's 15 banks. And you think, wait a minute. And the other thing is, the other bank, the big bank that's in the news is Credit Suisse, which immediately you think, okay, if it's Credit Suisse, then why are there 15 banks showing up for auctions? And then, as you said, George, now it's the latest auction, which was held yesterday, I think effective today. I don't think it even shows up on the Fed's balance sheet until later today, but now we're up to 11.01 billion, 17 banks now, which is interesting because that's probably the 15 from last week plus 2 more, but the 15 from last week were bidding almost double what they were last week. Mm-hmm. So something is going on here, especially when you consider this is a geometric progression at Swiss dollar auctions in Switzerland, when there's not supposed to be anything going on at these auctions. This is supposed to be nobody. Yeah, here we are with 11 billion in 17 banks, and you think, okay, there's something going on here that can't just be about Credit Suisse.
Yeah, and I tweeted about this yesterday, and a lot of the pushback I got was, "Oh, George, you idiot! You're fear mongering. It's $11 billion. Are you kidding me?"
Yes.
Warren Buffett could write that check, out of his account with B of A or whatever. Who cares? Why are we making a fuss about this? And I said, no, you don't get it. It's not about the dollar amount. It's about what this is telling you. This is telling you, and correct me if I'm wrong, that the counterparty risk has increased to the degree to which the banks aren't producing enough dollars themselves, because they could produce these dollars. The banks have the ability to do that in the Eurodollar system, which you always point out is cashless and reserveless. They don't need the dollars from the Fed to actually produce more dollar credit. But they do if the counterparty risk increases to the point where there's some of these, or the collateral, it decreases to the point where there are no banks willing to create the dollars needed. Therefore, they have to go to the Swiss National Bank hat in hand. Do I have that correct?
Yeah, and that's two good points there. The first one is 11 billion isn't a lot. It really isn't, but it is for Switzerland. If you look at their history of dollar swap usage through all the three crises so far, meaning 2020, 2011, and 2008, 11 billion is a lot for Switzerland. It's actually a lot. But the fact that there's anybody there at all and that it's increasing and that 11 billion is a pretty substantial number, maybe not in the grand scheme of things, but again, for Switzerland, and it's greater than zero, which means that banks who do not want to do this are being forced to do this. And they're being charged an extraordinary premium that they say, I don't want to go to Switzerland and bid for dollars, but I'm going to have to because I can't find a reasonable amount of funding in the private marketplace. And so that raises the question, what is the difficulty? Is it that they're being charged a high rate and that the Swiss dollar auction offers a more competitive rate? Again, you only do that in sort of a worst case scenario. Or is it that I used to use Italian government bonds in repo, usually as a collateral for collateral swap, transforming my Italian bonds into treasuries so I can borrow in US dollar markets. Now the market is saying, have you seen spreads on Italian government bonds lately? They're not really that good. So now you have an increased haircut, which means an increased margin or an increased cost in the private markets to swap Italian bonds for treasuries, which means it's more difficult in the private market to raise funding, which means maybe I go to Switzerland and beg for the Swiss National Bank dollars there. But again, I think the big point here is we're not saying this is the end of the world. 11 billion is not a lot, but it's greater than zero. It should really be zero. And so around the edges, we're starting to see erosion and escalation in dollar funding where consistent with past periods where this has happened, it's not good. It's not 2008, but it's a definite sign of escalating problems in the global Eurodollar system, whether that's collateral, whether that's something else, whether it's contagion for Credit Suisse. I don't think so. I think it's more about collateral than anything. We don't really know why banks are bidding at Swiss National Bank. But again, the fact that they're doing it at all should get your attention.
Yeah, right. And to be clear, the dollars they're getting from the Swiss National Bank, those are expensive dollars. Is that I don't know what I think.
Relatively speaking,
like
there's a term. Yeah, George, there's a term of art here. Because when these foreign exchange swaps or central bank liquidity swaps were first instituted way, way back in December of 2007, they were priced at OIS plus 100, which was consistent with the idea here that you don't want banks showing up to your auctions and funding their regular activity, so you charge a penalty rate.
Right. Walter Badgett, you always talk about that,
down over time. 2011, it was in November 2011, during that crisis, nobody was bidding for dollars, even though there was a clear dollar issue. So the Fed said, we'll cut the penalty to 50. And then in March 2020, again, this is, these dollar swaps don't work in a crisis situation. Nobody bid for dollars at these dollar swaps, even though everything was going haywire, until the Fed cut the penalty rate to OAS plus 25. I believe that was March 15th, effective the week of March 20 something, whatever it was in 2020. And then suddenly banks were willing to pay for it. So it's a measure of relative expense or perceptions of expensiveness, as well as inefficiency in private funding. Because again, you don't want to go to the Swiss National Bank unless you have to. Even if the penalty rate isn't 100 basis points like it used to be, a dozen years ago, still, the last thing you want to do is go to a central bank to fund on a weekly basis and then fund more the next week and more the next week. It's a sign that something is amiss here.
So maybe this is a kind of a beginner question, but these banks that are accessing the dollars via the Swiss Central Bank, why aren't they going into the U.S. repo market? Is because the repo market there is just shunning them? Or maybe another question would be, why aren't they going directly to the Fed? Because doesn't the Fed have a repo facility that's outstanding that is open to international counterparties?
Well, if you have a U.S. based subsidiary, first of all, it's a good point to start with. The Federal Reserve cannot operate or conduct do transactions with foreign banks. Now, it can. Foreign banks is a legal term, which, if a foreign bank has a U.S. based subsidiary, that U.S. based subsidiary is considered a U.S. bank. So the Fed can do business with a U.S. based subsidiary of a foreign bank. But if you are a foreign bank and you don't have a U.S. based subsidiary, then you can't do anything with the Federal Reserve at all. You're basically left to whatever's going on in the marketplace. So right away, we've kind of narrowed down our list here. It can't be foreign banks who have U.S. based subsidiaries, unless there's some funding, unless there's some interest rate differential, collateral differential, which again narrows down the list. If there's a collateral differential that makes you prefer the Swiss dollar auction to something that the Federal Reserve is offering. This is why I think, again, this is just my speculation, why I believe it has to do with Italian bonds, is because you can't show up at the Fed's window in your US-based subsidiary and try to pledge Italian bonds and get dollar funding. But you can, I believe, I'm pretty sure, you can at the Swiss National Bank auction because they accept Italian bonds as part of the collateral. So to me, it would make sense why we're looking at the Italian government market and saying, as that breaks down again, which it did in 2020, in 2018, in 2011, in 2007, and 2008. So there is a repeating pattern here that creates a collateral shortage that targets Europe, in particular, European institutions that do need dollar funding, why they would be accessing the Swiss National Bank. Again, I could be completely wrong because I don't know and nobody will ever know. But when we look at the facts that we have, it seems likely that it's banks that have euro-denominated collateral, Swiss bank or Swiss or Italian bonds or something similar to that, and they're using them at an eligible U.S. dollar auction in Switzerland because that's probably the most convenient and most likely relatively cheaper alternative.
Yeah, and some of the other pushback I got on Twitter is that, oh, George, this could be anything. This could be them just using dollars to do some sort of risk on type of trade. And I said, yeah, basically, but
talk about denial. I mean, come on.
Yeah,
if that was the case, then why don't we ever see dollar swaps or any of the Fed's credit windows get used when we actually see risk on behavior? It's always the opposite. When you see dollar swaps go up, that's never a good time. It's always a risk off period because of course it is. The lengths that people will go to try to deny that there's something going on here is just incredible. It's remarkable. We've seen a clear escalation. And by the way, we could see this coming. I've talked about this on the podcast repeatedly throughout September into October, saying we're seeing a third deflationary wave build. You saw T-bill rates go through the floor. They're incredibly low. SOFR was low when it shouldn't be, well below RRP. So all number of indicate the interest rate swap market, interest rate swap spreads plummeted toward the end of September, even before we got to this. Huge deflationary warning. So it's not like we're focusing on one issue, the Swiss National Bank, and saying, aha, there's this one thing that's happened. No, that's just a small thing in this wider picture where all of these other things fit together. Right. And it's one thing after another. George, I know you let me talk here, but another thing we saw just this week on Tuesday, the 3-month 10-year spread in the Treasury market, the yield curve, inverted for the first time.
I was just going to mention that. I was just going to say that.
We've seen these things telling you there is something going on here. And it's, we know what's going on, but there's something serious going on here. And the fact that it's finally led banks overseas to nibble at some dollar funding at a central bank, which is something they do not want to do, it's consistent with everything else.
Yeah. And, it reminds me of all the same people on Twitter, whatever it was 6-8 months ago, when the 2 and the 10 inverted. And they're saying, oh, this is nothing. It's just for a couple days. And, oh, who cares? And, stop fear mongering or whatever. And I remember you on your podcast saying, yeah, but it's got to start somewhere. Right. It's not like when we have an
one day the curve is nice and steep, and the next day it's 100 basis points inverted.
Yeah, exactly. And now, to your point, we've gone from the 2-year to the 1-year to the 6 month.
It just keeps moving and moving and moving.
Yeah,
and
now
George, I think part of the problem is most people have it in their minds, or at least people who don't follow these things carefully, that it's when these things happen, they happen overnight. Like you go from normal to crash in a day. And that's just, these things are long and drawn out processes. Even the 2008 crisis began in 2006. You know, it was a 3-year period where things just started going wrong a little bit, and then escalation. And every time you had an escalation, another warning come in, everybody would say, no, you're just fear mongering. That's nothing. The Fed's got it covered, all this stuff. And this is just how it goes.
And we pulled up, I say my research assistant, Josh. By the way, Josh, why don't you chime in here, buddy?
Hi, Josh.
I wanted to show you this. So when I was Josh's age, I had a picture of Carmen Electra and Pamela Anderson on my wall. But you'll notice that Josh has none of those. He has yours truly, Jeff Snider, poster on his wall. What do you think of that?
I have no words for that. I did not pay Josh to do that, though. I think I probably owe you some dollars here. So I'll pay you in euro dollars, I promise. Yeah. I'll get them from Switzerland.
No, he actually had it on his wall yesterday, so we were getting a kick out of that. But anyway, Josh pulled up the spreadsheet from the Swiss National Bank's website, and I saw the first entry was December of 2007. And I noticed that's, I guess that's when they implemented these swap lines. Oh, there you go. Here we go, right here. That was the first one. But I noticed that these swap lines, were pretty much every single week, and there was demand for these dollars every single week. It was very, very consistent, although it only peaked out at about, I think, 23 billion, something like that. So my point was, if you were paying attention back in 2007, you could have seen the cracks in the system way before Lehman, way before Bear Stearns. And, we saw the same stress in the banking system during COVID. And we see these swap lines being utilized there as well. So the fact that they're starting to be utilized, there are no certainties. There are only probabilities. But every single week that we see these things, these auctions take place where there are actually bidders and counterparties showing up, it increases the probability that we're going into another, serious type of recession or economic downturn.
Yeah, and I think that's what the inversion represents, right? The market is saying something's bothering us. There's really something bad out there. The probability is that eventually something shakes the FOMC out of their rate hikes. If we want to boil it down to and distill it to its base case, an inversion says lower rates in the future. And the Fed has said, look, we're going to focus exclusively on the CPI. We are going to hike rates until that sucker comes down and stays down. And the market is saying, yeah, but you're going to focus on the CPI. We're still betting that you're going to end up stopping your rate hikes and turning around anyway, even if the CPI stays high, which it's been sticky as it is. Even though I think it's going to go lower, it may not go lower on its own fast enough for the Fed to stop its rate hikes. But the market is betting anyway that something stops the Fed in its tracks. And that narrows the list of possible suspects down even further, right? What could get the Fed that only wants to focus on the CPI to stop focusing on the CPI? Well, a global dollar crisis might be something that would do that, right? And so if we start to see, like in 2007 or March of 2020, where banks are bidding for overseas dollar swaps at the Swiss National Bank, that sort of says maybe there's the start of something that could lead to the Fed out of its rate hikes. And as you said, George, back in 2007 and 2008, there were billions in dollar swaps, and yet we still had the crisis anyway. These things are not effective as a crisis management tool. There was 62 billion in dollar swaps available and used in the months before Lehman. The day Lehman failed, there was 62 billion in dollar swaps. So these are not crisis management tools. They tell you that the system is experiencing issues. So 11 billion, not a huge amount, but it starts somewhere.
Yeah, exactly. That's why I'm really going to pay attention to this every single Wednesday. I got it kind of marked on my calendar, because this and the inversion of the yield curve, to me, seems like the most important metrics to really follow.
That and some of the, again, like I said, it's never one thing or another. If it was just the Swiss National Bank, it was just these dollar swaps, you'd say that's interesting. It's something worth pay attention to, but it's certainly not something to get worked up about. But when you have interest rate swaps going haywire, you've got, as you said, George, the yield curve, euro dollar futures inverted, the dollar's exchange value that is just skyrocketing. These are all warning signs that we're experiencing a dollar shortage. And then you've got pretty visible stuff going on like Japan, China, the UK. I mean, gross global instability, which is consistent with major issues. And then at the end of all of that, you see something like Switzerland, and you're like, that makes sense.
Can you go over the tick data? Because I know you just tweeted a chart yesterday that showed and basically maybe explain what it is, these foreign buyers coming in and buying long-term treasuries. I think they've actually on their website, I think they've got it broken down by long-term and short-term as well. And then one specific question I had was I noticed on their website, they break it down by private and official. And I could not figure out, I was on their website for probably an hour yesterday, and I could not figure out how they're defining official. So can you maybe shed some light on that and then go over what's happened recently with the tick data?
Yeah, the official is just what the name implies, which is either foreign central banks, reserve managers that are tied to government or finance ministries around the world. So basically, any kind of overseas government, typically central banks, but also reserve managers.
Got it.
So they own lots of U.S. treasuries, as we all know, and they are the ones that tend to be selling during dollar shortage periods because, of course, they are. They need to sell the reserves to make up for dollar shortfalls that their banks are experiencing in their local jurisdictions. So they use their reserves to try to subsidize or even at times fill in the borrowing gaps that their banks are experiencing. So foreign officials tend to sell their treasuries during dollar shortages. Now, private firms, either commercial banks or even just wealthy individuals, mostly commercial banks, though, they do the opposite. When we have a dollar shortage period, we see the yield curve invert, for example, they're buying U.S. treasuries. They're buying long-term U.S. treasuries, not bills necessarily, but long-term U.S. treasuries, because they're preparing for the inevitable consequences of where these dollar shortage deflationary periods inevitably lead. You've got recession problems, you've got financial problems, and during those circumstances, the thing you're going to want to own is safe and liquid instruments, especially if it's denominated in U.S. dollars. So the ups and downs throughout the last 15 years match perfectly. Foreign officials sell their treasuries because they have to fill in the dollar shortage. Private foreigners tend to buy U.S. treasuries because they're sheltering themselves from the storm. Yeah. As you're showing here, in August as well as May and August, record amounts of U.S. long-term U.S. Treasury buying. Yeah. So when you look at the yield curve inverting, in particular since June and into July, when it really inverted, a lot of it was foreign buyers.
Yeah, and I will also, Josh, can you throw that back up? I also want to point out that if you go to the TIC website, I forgot what it's called, then you can see, to your point, Jeff, that when they break it down by private and official, the official is actually a net negative for the last month, which the last month of date is August here, where the private is obviously a net positive. So the private was like 85 or something,
huge.
And then the official was a negative like 8.2 or something. So this is exactly what you're saying. We're seeing it play out right in front of our eyes in real time here, where the private sector are net buyers and the public sector, if you will, net seller.
Yeah, and don't they know that the Fed's hiking rates? Well, of course they do. So they're buying these bonds knowing the Fed's going to hike rates. Why? As before, because they realize at some point the Fed's going to have to turn around. That's the yield curve inversion. And here in the TIC data, we actually see the yield curve inversion in action. I wish the TIC data was more up to date. It's a couple months old, but still, It's incredibly helpful in at least going back and saying, this is what we saw happen in the real world, and here's the data behind what was going on, which then leads us toward what we're just talked about, which is Switzerland and these dollar swaps. It's consistent with all of these things that we see around the world. So we're not focusing on the dollar swaps of the 11 billion. That just represents an escalation in a whole sea of escalations that have happened, especially since the middle of the year.
I think a lot of people, especially in financial media, they see the Fed lowering rates as something that would 100% definitively be positive for the stock market, like risk on, well, if they're lowering rates, well, that means stocks go up. But I always kind of pump the brakes there and say, well, wait a minute here. It depends on why the Fed is lowering rates. If they are lowering rates just because they're geniuses and they somehow orchestrate this soft landing, then maybe. But I think more likely, if you look at what's happening with the swap lines, you look at what's happening with the yield curve, it would imply that the reason they're lowering rates isn't because they have this soft landing, but it's because we have some sort of crisis situation like 2020, where even if they come out and say they're doing QE infinity and dropping rates down to zero, the market the next day still goes down by whatever it was, 1,500 points. And I'm referring to, remember back in March where they were supposed to have a meeting on Wednesday and they had an emergency meeting on Sunday where they said, oh, we're committing to $1 trillion a day in repo and we're dropping rates down to zero and doing QE infinity. And like the next 2 days, the market just still completely tanked and it didn't reverse until they announced the fiscal.
Yeah, that was March 15th. I remember it was Sunday night. That ridiculous press release that said basically we're going to do everything and anything.
Yeah.
And immediately the stock market jerked higher, and then it went lower. It just crashed into the open because everybody said this is ridiculous. And that's also the same press release where they said we're cutting the dollar swap penalty to plus 25 from plus 50, which unleashed actual dollar swap activity. Which
I didn't know that.
Again, it's just. This idea that the Fed is just going to save the world it doesn't go along with what we've seen in history. Especially, the Fed aggressively cut rates starting in September of 2007 too, and that didn't work out so well either. Not only did they aggressively cut rates, they did all of these liquidity operations that today we take for granted. But remember, back in 2007, we thought, holy crap. These things are novel. They're brand new. What is going on here? And of course, they didn't have any positive effect either. So there is, as far as stocks go, there is some psychological impact from the Fed because lots of people in the financial services industry want to buy stocks. They want to buy more stocks, and they only want to buy stocks. And if they believe that Jay Powell gives them the cover to do so, they will buy stocks because they can pick up the phone to their clients and say, the Fed is printing money. Let's buy some stocks. So there is some psychological impact that has been shown, but whether or not that's enough to overcome some of the more serious downside cases like 2020 or 2008, that's a different story altogether. And that's where we're really, the thing that's in the back of your mind when you see the Swiss National Bank and these dollar swaps is this is more than just a garden variety downturn. This is more than just kind of sort of interesting. There's something there, and the market being as hedged as it is, the yield curve inverted as it is, swaps market as bad as they are. There's something going on here, and as I said, banks don't want to go to Switzerland and bid for dollars, but they're doing it anyway. And again, there's no shortage of potential suspects of why that could be, starting with collateral.
Let's talk about psychology for a moment. I was just at the New Orleans Investment Conference. I was speaking there. I always admit that I'm the amateur, but I was speaking there with a lot of people that are considered pros. And I really enjoy talking to these people, and they're incredibly smart, but 99% of them, I was very frustrated when I heard their presentation because they still hold this belief that we need the Fed to create dollars, right? And I've tried to explain this many times on my channel and on my whiteboard, but I still have a hard time really getting through to people. And I was wondering if you had kind of a trick for this. So when I read the comments and when I hear these pros, or if you will, at the New Orleans Investment Conference, they act as if dollars, today's version of dollars, are literally gold coins, and the banks can't produce them. Now they can maybe produce paper claims on those gold coins. So if you have 10 gold coins, maybe you can produce 90 claims, paper claims against those gold coins. But in order to create more loans, well, then they need the Fed to give them more of these gold coins. And what I try to get through to people is, you don't understand that the banks can create as many gold coins as they want. There's nothing that limits the bank from creating their own gold coins except for counterparty risk. So and I think it gets confusing, doesn't it, Jeff? Because the people see these swap lines being utilized, and it would make sense. It's very intuitive to say, well, the banks need dollars. Obviously, the banks can't create as many dollars as they want, or they wouldn't go to we wouldn't see these swap lines utilized at all, or we wouldn't see the Fed get involved and produce liquidity or inject liquidity, because the banks can do it. But what they don't understand is the banks still have the capacity to produce as many dollars as they want. There is no limit. That is not a scarce resource. The only thing that's scarce is the bank's confidence that the counterparty will pay them back. That's what the scarce resource is. So, but I think that's just a flaw in so many people's thinking, and they just can't get their head over that. And so it leads to a lot of inaccurate conclusions, I guess. So what are your thoughts on that? Am I right? Am I wrong? And if I'm right, do you have a way of communicating that to people that maybe I haven't figured out?
No, you're absolutely right, George. And it's incredibly difficult to get people to make that intuitive leap, because it's not intuitive. It's not immediately intuitive. But once you see it, you cannot unsee it. And it's one of those things where it's, we're all taught about fractional reserve lending. And so in a fractional reserve lending situation, you have to have a reserve. And that reserve, we're all told, is either Federal Reserve notes, physical cash, or some form of gold, or whatever it happens to be. So this concept of base money, and not only that, base money being government money, exclusively government money, is deeply ingrained. And it's deeply ingrained for a variety of reasons, including because it tells a story that is very favorable to those supposedly creating this supposed base money, right?
Right.
If you believe the Fed creates base money, that puts the Fed in the central position, which is where it wants everybody to believe it is. But it's absolutely not true. So what I have done in our Eurodollar University member videos, shameless plug here, is at the beginning of each of these videos where we go through money creation and how banks actually transact with one another in money creation. At the beginning of every video, I show this quote from Milton Friedman from 1969, where he says, the amount of actual cash in these banks, in this Eurodollar system, is negligible. Think about that for a second. It sounds like, what is that? I mean, that's so incredibly simple. There is no physical cash in the Eurodollar system. So what are they actually fractioning? What is being multiplied to create these dollars? Now, Friedman said it was, well, some connection to New York banks or something like that. But in reality, when you start to do the diagrams, you realize there is no reserve. There is no base money except what you just said, George, which is balance sheet constraints that are, idiosyncratic, but largely boil down to counterparty risk. How do you manage risk on your balance sheet? But getting people who have been conditioned to believe in base money and reserves to see that truth without actually doing the work to do it, it's incredibly difficult. But that's a good place to start when you realize, or when you say, look, there is no physical cash. When these banks are settling transaction, they're not hiring guards to get pallets of cash onto airplanes and then flying them around the world. They're simply keeping track of who owes what on a ledger. These are claims on other forms of dollars when nobody wants the other forms of dollars. They only transact in this funny money virtual currency.
Right.
The other thing that you can say is that this is nothing new either. This kind of ghost money or fictional currency goes back, ledger money goes back centuries. So that's another misconception too. You hear that all the time, that governments have always held a monopoly on money. You just shake your head. That's just not true. Currency has been more of a private affair than not throughout human history. And if you give banks the ability to create currency, you better believe they're going to use it so long as they can. And when they can't, as you just pointed out, Then they're forced to do all these other things. Markets go haywire. They go back to the Fed for some form of other alternative liquidity. It all starts
and that leads the people to believe that they don't have the ability to produce those dollars themselves.
Right.
Yeah, that's the kind of the ironic twist here. And when you said when you're talking about going back 500 years or 1,000 years or whatever, and them saying that the governments are in charge of the money or the currency, I want to be clear there that those people or those entities that were involved in creating more quote unquote currency weren't necessarily creating more pieces of paper or more coins. They were simply creating more purchasing power just by extending credit that they would mark down on their ledger. And so that's all that it was. That's all purchasing power. Well, there was more to it, but the purchasing power we're talking about, all it is entries in a ledger. And back then it was paper. Today it's on a computer screen in the network that is the Eurodollar system.
Yeah, but even in the 19th century, banks printed paper currency. Paper currency wasn't a government issue; it was a bank issue.
Right.
So even the modern convention is to do it in a computerized ledger, but they also printed paper currency too. So banks have printed their own currency for as long as there's been banks. I mean, you go back to the Knights Templar, for example, there was always paper currency, which isn't just another form of ledger, except it's a bearer form of ledger. But by and large, it's the same concept. A reserveless system is not something new, but we've been conditioned to believe that it can't exist, that no money can exist outside of the Fed or the Treasury or whichever government. And it's simply not the case. But you're right. It is incredibly difficult to get people, first of all, because everybody says it's otherwise and everybody can't possibly be wrong. So you're already swimming against the tide in that respect. And then you're right. You have these times when during periods of trouble, banks they find whoever doesn't have counterparty risk, which just so happens to be the Federal Reserve. And so they find the one person in the tide of deflation that doesn't suffer from deflation. That doesn't mean what everybody thinks it means.
I also want you to fact check me here real quick, because one of my theories and one of the reasons I don't like when people say the Fed injects liquidity into the market is because it assumes that the treasuries themselves are somehow illiquid, or that the cash is more liquid than the treasuries. And I'm like, no, think that one through. It is true that if the Fed, let's just say the primary dealers don't exist and they were to buy a treasury from the average Joe. Okay, yes, M2 money supply goes up. But again, that assumes that the average Joe could not have sold that treasury and received money and therefore purchased stocks, or the pension fund. That's the example I always use. Imagine a pension fund being there and saying, oh my gosh, Jeff, we've got all of these treasuries on our balance sheet. We really want to buy stocks. I mean, we would love to buy stocks right now, but darn it, we just can't do it because we have all these stupid treasuries. If only the Fed would come in and buy these treasuries from us, then we would be saved because we would have the cash that we need to go in and buy stocks. You know, when you say it out loud, it sounds ridiculous. But when you just say the Fed injects liquidity, it's like, oh, yeah, of course. Duh. We all know that because everyone says it over and over and over again. So it has to be true.
We just say these things, right? We never think about them. And that's really, George, that's the reason I went on this voyage of discovery into the monetary system to begin with. Because way back in the 1990s, I started having questions specifically about repo, where you don't actually need to sell securities to raise cash. It blew my mind.
Right.
I'm like, you don't actually, what is this repurchase agreement? It's collateralized. I mean, and then you would ask people in the financial services industry, and they would just repeat the same stuff that you did. The Fed does the liquidity. We don't really know what happens. But whatever the Fed does is liquidity, and whatever happens outside the Fed is not liquidity. When in fact, treasuries at times are more liquid and more money and more like currency than anything the Fed has to offer. And that includes physical cash, because physical cash, nobody wants to use physical. The banking system, if you showed up with $1 billion in physical cash, they would turn you away. I don't want that cash. That's a burden. But if you show up with,
they would argue, to be fair though, they would argue that it's not the physical cash, but the bank reserves are what is more liquid than a treasury.
Yeah, but my point is the stuff that comes out of the Fed isn't necessarily as useful as some of these financial instruments, like a currency swap. A currency swap is far more like money than anything the Fed would do. Even though the Fed does currency swaps, they only do currency swaps with other foreign central banks. But a currency swap is used in the global marketplace, far more like money, yet it doesn't show up on anybody's balance sheet. And banks would much rather do a currency swap than anything that the Fed has to offer. They only go to the Fed or these foreign central banks when they can't find anything else in the private market, because the Fed does not have counterparty risk. That's really what it comes down to. It's not that they have liquidity, it's that they have a form of financial characteristic that is highly prized in these certain situations.
Okay, so we know the banks can create an unlimited amount of dollar assets and liabilities. We know that. But
it's never unlimited. I know theoretically it sounds like it should be unlimited, but it's never unlimited, because there's always internal constraints where banks say, you can't just extend credit forever because you'll be out of business tomorrow or the next day. So there's always some form of usually mathematically based constraint. So
that the banks impose on themselves.
Absolutely. It's simple governance issues, really, because you think about a bank and you think it's a bank, a single entity, but it's really not. You've got different groups within the bank doing all sorts of things. And how do you keep control when what they're doing is monetary, is financial? So you have to have some system of governance and constraint right from the get-go, even just to manage all these different various mandates that are going on in the system inside the bank, because a bank is not a single thing. So right away, there's internal constraints, and then they get tighter and tighter as you do more difficult and more esoteric things that really do go on inside the bank.
Okay.
And so they're really governed by a series of mathematical metrics.
So on paper, they could expand their balance sheet in infinitely, but in practice they don't, because of risk management.
Right, because you have to at least be able to manage and monitor what's going on inside the bank. You have to put reasonable controls. Otherwise, you'd have to go down to every single employee that has the ability to do what we say. As Milton Friedman called it, the bookkeeper's pen.
Right.
They would, you have to have some way of monitoring and managing the system. So there's already internal governance controls that are implemented, which constrain the ability of employees and people operating inside the bank to do what they otherwise may want to do.
But in a way, that goes back to counterparty risk, in the sense that if there is, let's just say there were zero perceived counterparty risk, well, then I would assume those those rules that they have for managing all of those employees, those would be a lot more liberal, and therefore they would be able to expand their balance sheet even further, although there would still be some sort of limit. So that brings me to the question.
That was the entire pre-crisis era.
Right.
When everybody thought the counterparty risk was extremely low. And so governance, these internal constraints were extremely loose, because recency bias, confirmation bias, we thought nothing bad has ever happened, so nothing bad can ever happen. That starts to filter its way into mathematical assumptions about volatility, correlation, all these governing principles that should constrain banks. But back then, as you said, there's no risk. So banks were able to expand way too much, which was the problem. But that's really, in very simple terms, it has nothing to do with the Fed, has nothing to do with bank reserve, which is why there was practically no bank reserves at the time. Everything was about the ability of banks to manage their balance sheets and grow and expand as they saw fit. Unfortunately, they did way too much of it because their constraints weren't realistic.
Okay, does regulation constrain them? So we've got the SLR, we've got Basel III, we've got the GSIBs, we've got all these things floating around. So, or can they maneuver their balance sheet around those regulations? That's what I've argued for the last few weeks, is that I can't imagine that these banks aren't ahead of the curve. I can't imagine they're not one step ahead of the regulators. And that I don't care how many Basels you come out with, there's still going to be a way. They're still going to find a way to increase the size of their balance sheet if they want to.
That's the issue. And you just hit the nail on the head. There's 3 Basels. Why didn't the first one work, right?
Yeah, yeah, right. It's like
Because
QE,
it's
right? Why do we need
that's the
3?
thing. As soon as regulators come out with rules, if banks perceive there's an opportunity to get around the rules, they will do so. And they will hire an army of lawyers, mathematicians, accountants, and especially lobbyists to be able to do it, which also describes the pre-crisis era. But the
Mm,
key in that situation is always if they perceive it's worth the effort. So in the
right.
pre-crisis era, there were tons of rules and regulations. That's another misconception too, that these cowboy banks were unrestrained by regulation throughout the pre-crisis era. That wasn't true. You could argue that the regulations weren't effective, but that's not the same thing, is it? So banks are always looking to go around. I mean, they want to do what they want to do. And if the government starts to get in the way, and if they think there's a profit opportunity that makes it worth the effort to go around the regulation, they're going to do it. So Basel III, HQLA requirements, all this stuff, it's only binding if banks think there's no opportunity that makes it worthwhile to circumvent those rules. So
Mm,
I lose patience with anybody argues this is about regulation, because banks had changed their behavior, and the Fed even talked about this in 2008, how banks were being balance sheet constrained to the point they weren't even arbitraging intraday free money spreads between Europe and New York. That wasn't Basel III, that wasn't HQLA, that was banks perceiving counterparty risk and saying, you go to the Fed because I don't want to deal with this.
right, right. Last question here, Jeff. Mark-to-market accounting. I know we've discussed this, and you think this was kind of the main reason why the crisis, the GFC, kind of ended, if you will, or the crisis part of it ended. But I'm under the impression that the banks now still don't have to use mark-to-market, and then if that's true, then I think to myself, okay, well, what do their balance sheets really look like? I mean, because the one good thing about mark-to-market accounting is prior to 2007, you could see, okay, what's going on with the asset side of these banks' balance sheet. But now, if they don't have to do that, um, how do we know what's going on? How do we know that these banks have a fortress balance sheet if we don't know the value of if they had to liquidate part of the asset side of their balance sheet?
Yeah, this is a sticky issue, and there really is no good answers to it. I mean, you think about it in the context of Credit Suisse today. I mean, they're talking about selling off a bad bank and not an inconsequential bad banks, which means what is in the bad bank and what makes it bad and just how bad is it?
Right.
But going back to the crisis era, I actually do have an incredible amount of sympathy for the banking system because they were forced to value their assets based on illiquid market inputs, essentially
Mm,
markets that had gone haywire because the Fed doesn't know what the hell it's doing, forcing down the price of all these markets for all these hard to otherwise price assets, which meant they were not true representations of their balance sheets at the time. Which I know people immediately say, "Oh, are you kidding me? Subprime mortgages, toxic waste." No, history has shown that most of the assets that were marked down by illiquid markets were actually money good assets. There were no actual credit losses, or very few credit losses from the 2008 crisis. The Fed made billions of dollars once it bailed out AIG and took its assets from it because those assets were mispriced by illiquid markets. So suspending mark to market actually made some sense. Now, does it make sense in all environments? That's really the issue here. But
yeah,
you're
because
right,
it can
George.
misprice things on the low side, but it can also misprice things on the high side.
Absolutely. And that's that again, there's no easy answer here. And you're right, the mark to market has changed since 2009 in a very permanent way. It's not, if you choose not to market, you have to put the asset into your book, which means you better not sell it before it matures. Otherwise, you incur the wrath of all sorts of regulations and accounting issues.
Okay.
So if you choose not to, if you have an asset you don't want to market, you're holding that sucker till it expires or matures.
Got it.
Otherwise, you're just gaming the system, and the regulators will come down on you for that. So, but you're right. If you put something in your book that may not be, it's sort of questionable, and you're just kind of waiting for maturity that's 10 years down the road, and this sucker isn't going to pay off at maturity, you're essentially hiding losses, right? And you can think of any number of, excuse me, any number of cases, especially in Europe, energy market, CLOs, things like that, that are illiquid prices, where banks, if they do have them in their bank book, not in the trading book, maybe we don't have a good idea of what those assets are worth. And we may never have a good idea of what those assets are worth. And it contributes to information asymmetry, where the market says, I don't know what your assets are. I don't know what they're valued. So I'm not going to lend to you in dollars today. You go to the Swiss National Bank, because even if you do have good assets and you tell me you have good assets, there's no way I can tell and check your work.
Yeah. Yeah. Jeff, first of all, thanks a lot for your time, man. As always, you've helped me understand the system far better. We've got about 1,800 people on the live stream right now. I want to encourage every single one of them to not only check out your podcast, but also check out your membership site. Can you tell us about what you're doing over there? I know it's Eurodollar University, but I don't know if there's another name that you have for it, or how can people go over and check out what you're offering there?
Yeah, they can go to our website. It's eurodollar.university. And there's a couple different things. There's memberships where we do these types of educational videos, and I do Q&As and things to help people understand how the system works. There's research products there. There's one that I'm partnering with Steve Van Meter and Tracy Schuchart, where we talk about more current events, deep dives into what's going on in the markets with more of a financial sort of a viewpoint there. But all that stuff is available at eurodollar.university. Basically just trying to help people understand what's going on what's really going on, that isn't just don't fight the Fed.
Yeah, really. And I think for people that are really trying to manage their own portfolio and their kind of financial future, they have to be aware of not only the risks in the systems, but all these metrics that you talk about, the mainstream media just completely ignores. And they also have to understand how the global monetary system works. I just don't understand how you can predict the probability of XYZ asset going up or down if you don't even know how money works. It blows my mind. So you guys have to go check out what Jeff is doing over there. If you've got a portfolio, if you're an investor, I think it's absolutely mandatory.
It is, but George, one last thought. It is understandable why people have so much difficulty, because economics and the mainstream media have done such a piss poor job of educating the public about how these things work. And then in a sense, that's understandable, if not condonable. But, there are a lot of people now who are who are just fed up with all this nonsense, Fed, and all this stuff, and are really looking for answers. So, in my experience, in my career, the amount of people who are actually asking the right questions has gone up exponentially over time, which is a good thing. And it's people like yourself, too, that are helping guide people in the right direction. And that's the reason why you exist, George, is because they've done such a horrible job that people just want something that they can say, oh, this actually makes sense. It can't just be, oh, bank reserves are several trillion, just do whatever, risk on forever.
Did you you probably didn't see it, but I was on Fox Business the other day, and the Charlie Payne, really great guy, but he asked me about 4 questions, something like that. So the last question he asked me was kind of like, oh, what advice would you give investors right now? And basically what I told them is, you've got to figure out a way to go long political stupidity.
Stupidity, incompetence, and ignorance. the unholy trifecta.
There you go. All right, Jeff, it's great to see you, buddy. Thanks for coming on.
George. All right, take care.